Welcome to this Killick Explains video, and welcome to part 1 in a 4-part series on equity analysis. And I suppose not surprisingly, I'm going to start with what is equity analysis, and then we'll take on some of the key ways of assessing whether a company is cheap or expensive in future videos. So, what is equity analysis? Well, investors should aim to do basically 3 things. 1, find good companies. 2, not pay too much for them. And then 3, hold on to them. So this is a long-term investing approach. I am not doing equity analysis for the purposes of day trading or making a quick buck in the next couple of hours. Okay, so briefly, what is finding good companies? Point number 1. Well, I'm going to summarise a lot of stuff here that I cover in more detail elsewhere, and I'll give you some hints and tips as to where at the end. But it's all about finding companies with brand strength and depth, established brands that can see off the competition. You also want a consistent track record when it comes to earnings, when it comes to cash flow, when it comes to asset growth, and so on. More about that in future videos. You want strong management, and ideally you want not too many vacancies at the top, and you want evidence that people have steered similar or identical companies through difficult patches as well as growth phases. So in other words, you want robust, diverse management teams. You want a decent moat. You want to be able to look at the company and say, how is it going to fend off competition? Not just today, but over the next 5 or 10 years. You know, what are its competitive advantages? What are its competitive threats? And there's a whole industry built around what's called deciding, as Warren Buffett called it, how wide a company's moat is. And all of that adds together into staying power. In other words, you're looking for a strong brand run by a team with depth and breadth that can stick around for the next decade or longer. Now that's finding good companies. So what's the not overpaying bit all about? And then holding on to them is the easiest part in a way, not churning the portfolio. Well, let's look at not overpaying. And some of the videos I go into next will look at what are called key ratios, key metrics. And there are 3 I want to look at in future videos in more detail: the price to earnings ratio, the price to book ratio, and the price to cash flow ratio. In other words, looking at earnings, assets, and cash flow, the 3 main primary statements in a set of accounts. Now, that's going to be part of the activity of not overpaying. Benchmarking is going to be important. Once we've calculated these ratios, we're going to be trying to work out what we should compare them to, whether that be the company's immediate past, whether it be projections from management, whether it be the wider peer group and market. And thirdly, there's going to be some judgment involved here. And the judgment's going to come in when we consider, for example, which of those ratios is most relevant and what the key drivers for a particular business might be. Now, finally, I want to say a little bit about what holding on to investments means, having looked at finding good companies very briefly, not overpaying for them. Holding on is all about thinking long term, not short term. A low churn on the investment or the wider portfolio, not buying and selling too often, not reacting to short term news. Making sure you are diversified, that's a key plank of equity investing. And finally, rebalancing. So if a position grows and shrinks as a proportion of your portfolio, which it will do, we're not then looking to sort of start dumping stocks simply because the position has shrunk relative to others. We might be looking to rebalance to maintain a roughly even weighting, let's say, across a mixed portfolio. So there you have it. For further information about some of the points I've just made, other than the 3 videos coming up, I can recommend 3 sources of information. 1 is my video library, killick.com/learn, and you've got a shares tab and a ratios tab on this side. There's also my how to invest in equities guide, which is light blue, and that will be editor@killick.com for a copy of that, either hard or digital. And then there's Confidant next to me, our quarterly magazine, where the equity research team at Killick talk through some of their best ideas and reference some of the concepts I've been talking about here. And once again, that will be editor@killick.com.